Iran war update. Oil jumps, bonds drop, dollar surges. What this means for stocks, gold, and your portfolio today. Stop scrolling, because this is the update that matters today. Over the last 24 to 48 hours, the conflict involving Iran has moved from headline risk to market-moving reality. Oil jumped. Stocks got hit. Bond yields moved in a way that tells you inflation fears are back, and the dollar caught a bid as money ran for safety. This is exactly the kind of shock that can flip the market narrative in a single week, from rate cuts and a soft landing to inflation returns and risk-off. So in this update, I'm going to break down what we know right now, what the market is pricing right now, and what your portfolio risks are right now. And stay until the end, because I'll give you a practical framework. What to watch over the next 72 hours. The 3 market scenarios from here. Which sectors can benefit? Which sectors are most exposed? And how to position without panic. This is Mindful Minds and Money. Let's get into it. What changed today in the markets? Let's start with the hard signals. Oil surged on the escalation of conflict and mounting concerns about energy production and shipping disruption in the region. Reuters reported Brent crude spiked as high as $82.37 before pulling back to around $77.79, while U.S. crude hit about $75.33 at the peak. And it wasn't just oil. Reuters also noted major spikes in natural gas benchmarks, with Dutch TTF and Asian LNG jumping sharply, showing this isn't simply a temporary oil headline, it's a broader energy risk premium being priced in. Then look at the classic fear dashboard. The dollar rose as investors moved defensive. Gold surged on safe haven demand. Treasuries sold off because inflation fears returned, and traders trimmed rate cut expectations. This is crucial. Normally in panic, bonds rally. But today, the story includes inflation risk from energy, so yields can rise even while stocks wobble. That's the signature of an oil shock narrative creeping back into markets. On the equity side, pre-market reports showed U.S. index futures sliding while oil jumped, which is the market saying, higher energy costs shets us tighter financial conditions. So what changed today? The market is repricing one thing: the probability that energy disruption lasts long enough to affect inflation, growth, and rate policy. The real battlefield is the Strait of Hormuz. Now, why is this so sensitive? Because the market's biggest fear isn't tweets, it's not rumors, it's flow disruption. Today's reporting and analyst notes emphasize that if the Strait of Hormuz is disrupted, oil can move sharply higher and stay there longer than most investors expect. One analysis cited by Rigzone, referencing Wood Mackenzie, said closure risks threaten a meaningful share of global oil and LNG flows, and oil could exceed $100 if flows aren't restored quickly. Washington Post reporting described severe concerns tied to traffic disruptions and escalating risk around the strait, with sharp moves in diesel and broader energy markets and knock-on effects in equities. Here's what you need to understand. This isn't just Middle East conflict. This is the market pricing the question: can energy actually move? Can tankers actually transit? Can insurance cover it? Can producers export reliably? And when the answer becomes maybe not, the price response can be non-linear, meaning it doesn't climb smoothly. It gaps. Why oil at $90 to $120 is a different world? Let's talk mechanics. Oil is not just gasoline, it's a cost input across everything: shipping and logistics, manufacturing and chemicals, food and agriculture, fertilizers, transport, aviation fuel, plastics, consumer goods, supply chains. So when oil rises, it spreads. And today, markets are relearning something. Even if the price move is only to $80 to $90, the real impact is confidence. Confidence is what drives capex. Confidence drives hiring. Confidence drives consumer spending. When energy spikes, everyone pulls back. Now, there's a direct inflation story too. A Wall Street Journal market note pointed out research suggesting a 10% jump in real oil prices can add roughly 0.15 percentage points to inflation over the following year. That sounds small, but if inflation is already sticky and the market was expecting cuts, Even small changes can radically shift expectations. That's why bond markets reacted the way they did, and that's why the higher for longer narrative is creeping back into the conversation today. The market's new fear: rate cuts get pulled. Here's the key. If oil spikes and stays elevated, central banks face a problem. They can't easily cut into rising inflation. Multiple market reports today emphasized that higher oil prices are making traders rethink how soon and how deep rate cuts will be. This is why treasuries can fall even while stocks are under stress, because the market says inflation might return before growth collapses. That's a nasty mix. Equities hate uncertainty. Bonds hate inflation. Consumers hate higher fuel prices. And if you get both weak growth and persistent inflation pressure, that's the shadow word investors don't like to say out loud: stagflation risk. Even the hint of it changes how money is allocated. What stocks do in this environment? Now let's map this into the equity market. In a conflict-driven oil shock, 1. Energy tends to outperform. This is obvious. If oil rises, cash flows rise for producers. Reuters described oil and gas prices surging on the escalation and disruption fears. Investopedia noted energy names and defense contractors were among the areas seeing strength as markets reacted. 2. Defense tends to outperform. Geopolitical escalation increases defense demand and budgets, and the market prices this quickly. 3. Airlines, travel get hit. Washington Post described airline stocks sliding amid disruptions and fear. This is normal. Higher fuel costs, plus travel interruptions, checks margin squeeze. 4. High multiple tech can wobble. Why? Because the market ties inflation to higher discount rates. Even if tech companies have nothing to do with oil, their valuations do. 5. Consumer discretionary gets pressured because higher fuel prices act like a tax. People can't spend what they already spent at the pump. Gold, the dollar, and the fear trade. Gold surged today alongside the defensive rotation. The dollar also strengthened as the market went risk-off. This combination tells you something important. The market is not pricing a clean, risk-on reflation. It's pricing stress. When both gold and the dollar are strong, it often means global investors seek safety. Uncertainty is high. Capital moves to liquidity. Now remember, gold can have volatility. Sometimes it sells off briefly if margin calls hit equities. But the direction today aligns with classic safe haven behavior. What about Bitcoin? Bitcoin tends to behave in two phases during shocks. Phase 1, it sells off with risk assets, liquidity squeeze. Phase 2, it can rebound if the market pivots back to inflation hedges. Today's macro signal is inflation risk rising, so Bitcoin could see narrative support. But the short term depends on whether this becomes a sustained risk-off wave. In this update video, your best positioning is honest and balanced. Bitcoin is not a guaranteed safe haven in acute panic, but prolonged inflation stress can be a tailwind. Keep it practical. Your audience trusts you when you're straight. 3 scenarios from here. Now, the most useful part of this update: what happens next? Scenario A: de-escalation and flows. Normalize oil, gives back risk premium. Equities rebound, bonds stabilize. This becomes a headline spike, and markets move on. Scenario B: ongoing disruption, no full closure oil, stays elevated in $80 to $95 zone. Inflation expectations rise modestly, rate cuts get pushed out. Equities chop sideways with volatility. This is a grind scenario. Scenario C: severe disruption, Hormuz impairment, major shipping risk. Oil spikes toward $100 plus. Inflation fears surge. Bond yields jump further. Equities reprice lower quickly. This is when the market starts talking about recession risk again. Today's analyst commentary suggests the tail risk is real, particularly if flows don't normalize quickly. What to watch in the next 72 hours? If you want to sound like a pro, tell viewers to watch signals, not emotions. 1. Brent crude. Does it hold above the spike zone? 2. Gas prices. Diesel. Do refined products stay bid? 3. Dollar strength. Confirms global risk-off. 4. Bond yields. Inflation, fear versus recession fear. Today was inflation fear. 5. Defense and energy equities. Do they lead? 6. Rate cut pricing. Traders trimming cut bets is a big tell. And tell them one more thing. Volatility doesn't mean sell everything. It means respect risk. How to think about your portfolio without panic. Here's how smart investors respond to macro shocks. Avoid impulsive, all-in moves. Keep liquidity. Use staged entries. Diversify across regimes. In an oil shock environment, the market often rotates toward energy, defense, certain commodities, sometimes quality value, sometimes gold, and rotates away from airlines, travel, unprofitable growth, consumer discretionary. Long-duration assets if yields rise. But emphasize this. You don't need to predict the war. You need to watch markets price the risk. So that's the update. Today, the market is telling you one thing loud and clear. This conflict is not being priced as noise. It's being priced as energy risk. And energy risk becomes inflation risk. And inflation risk becomes rate risk. And rate risk becomes equity risk. That chain is exactly what you must watch this week. If you want me to keep updating this story as the numbers change, oil, stocks, bonds, gold, subscribe, hit the bell, and comment, update, and I'll make the next one with the newest data. I'm Felix, and this is Mindful Minds and Money. Stay calm, stay sharp, stay liquid, stay awake, stay aware. See you next time.